Assalamualaikum and hi, my name is Nadra Shanmibantu Zulkifli from class BA 243D. Today, I would like to share with you guys the difference between Islamic finance and conventional finance. So, let's get start.
What is conventional finance? Conventional finance is a home financing scheme offered by financial institutions or banks which are not guaranteed by government agency. It is also known as a transaction based on interest rate. For saving, surplus or deficit spending, you need to loan or borrow fund in financial market. Next is Islamic finance. Islamic finance systems are very similar to conventional. There is banking activity that complies with Sharia and its practical application through the development of Islamic economy that include mudarabah, murabahah, musyarakah, wadi'ah and ijarah. Okay, what is value proposition? A value proposition is a promise of value stated by a company's product or service will be delivered, experienced, and acquired. Okay, now for conventional finance. The value proposition of the conventional finance is geared toward consumer-friendly customer service that are meant to attract more customers with the objective of profit maximization. If the value proposition of conventional finance involves socio-economic benefit for the consumer, there would not be any need for socially responsible investing, which is gradually gaining ground as part of the aftermath of the recent global financial meltdown. Next, for the Islamic finance aiming on maximized profit based on Sharia and legislative requirement. Financial justice is a requirement that helps Islamic finance products function in a Sharia compliant way. Profits are shared between the bank and the depositor with a pre-agreed ratio that is not guaranteed. Structure is how the bank set up and their modus operandi. The basic difference between Islamic banking and conventional banking is the structure of how the bank is set up. For a conventional banking, the purpose of setup is to collect deposit and to give loan. So here are their modus operandi. First and foremost is shareholder give capital. Then bank receive customer deposit and invest. Next, interest received are distributed. Next, customer request for loan. Bank borrow interbank fund. Bank lends the fund at an interest rate. And finally, the most important thing is customer need to pay interest plus principal. Now for the modus operandi of Islamic finance. In Islamic banks, while income and pricing remains important, there is also consideration on why a product is launched and the impact it has on customers. Not all fees can be charged and not all features can be used in Islamic banking. The Islamic banking model itself is not a standalone arrangement. So the first thing is sources of funds, and then pool of funds, and then application of funds, and then Islamic banking contracts such as participating, supporting. Next is income from activities, and then distribution of income, which is less expensive. I think that the structure of an Islamic bank is most suited if it is built around the mudarabah structure. It fits perfectly on how the bank is to be managed. It should be the backbone of any Islamic bank, where the setup is linked end to end, resulting in sharing of actual returns arising for a Sharia compliant financing activity. Okay, now for the operational mechanism. Operating mechanism are the means of control over pace and direction of an initiative. This is the simplest, though still critical. Okay, the difference lies is in sharing of risk and reward. First, conventional. Reward is fixed and predetermined. Next is Islamic. Deposits are accepted through musyarakah and mudarabah, but where reward is variable. Then, total risk is borne by the bank and total reward belongs to it after servicing the depositor at fixed rate for conventional. Under the Islamic finance is risk and reward both are shared with depositor. Reward of depositor is linked with outcome of investment made by IFI. So, for instrument offer, there are four types of contract: participating, trading, supporting, and equity share. This is one of the example of the product that they provide: overdraft or credit card. Under conventional finance, conventional bank offered the facility of overdrawing from account of the customer on interest. One of its form is use of credit card, whereby limit of overdrawing for customer is set by the bank. Customer is charged with interest since the facility availed. And why under Islamic finance, as for facility of financing is concerned, there is not offered by Islamic bank except in the form of murabaha. However, facility to shop requirement is provided through debit card, whereby a customer can use his card if his account carries credit balance. And under murabaha, only profit is due when the commodity is delivered to customer.
Oh, wait. So, for the conclusion, I think that Islamic finance and conventional finance has its own strength, but I believe that Islamic finance is more better because it based on Sharia principle. But Islamic finance need to improve their system to attract more consumers. So I think that's all from me. Thank you.